Hi there, and welcome to another video by the bottom line. Uh, what a move it has been in Nifty in the past 2 months. It has just risen from 19,000 to 21,500 in absolute no time. Uh, while there are a lot of positives to this rally, it is also to note a few things about what is ongoing in the rally and what could be the scenarios that can happen. First of all, looking at these all-time highs, they are well supported. You can see a good range formation from here, and then again an explosive move all the way to the top. uh, if you would have looked at valuations somewhere around here, which they were around at 22, and as of today also the valuations are somewhere around 22.6 for the Nifty. Now what that means is that the prices have risen, right, in the past 6 odd months, but the valuation has not increased significantly as it was supposed to be. That means the underlying companies are doing excellent in terms of the EPS, the earnings per share, on most of the Nifty listed companies. While that is a very good positive, a valuation anywhere in the range of 20 to 25 is absolutely healthy. uh, but again, a thought is to be provided: would you invest something at these high levels, or is it better to wait when it slightly comes down here and you have a better chance to take more positions? Now we can continuously debate about whether this direction is the most likely direction or this direction is the most likely direction. But if you're looking for investments, uh, at least when I personally look for investments in my own style, the direction of Nifty does matter, but there is a deeper understanding that needs to happen around where this particular stock is, where the company is which you're interested in. If the company itself is trading at very high valuations, in most cases you will see that Nifty has shot up while the company you have invested in has continued to either be choppy or even decline a little bit, putting you inside a worrying zone and just boring you to it, and kind of be that frustrating stock in your portfolio. If we look at where we are in terms of the Nifty valuations, like I said, we are at 22.6, which is the valuation that is prevalent right now. Again, from a charting standpoint, like I said in the previous one of the previous sessions, this is a a big danger zone. This is where, at my personal level, again this is again a very very subjective preference, but somewhere at the range of 26 or 27, if the PE reaches in Nifty, uh, most likely I will be out of all the positions that I have in the equity markets. The reason is that whenever we see Nifty valuation shooting up, after that the companies which are already heated up, already overvalued, you will see them going in a range, right? And now, why do I exit such companies is obviously because they were earlier attractive, but now they've gone into the overvalued range. And I'll give you an example of what I have exited recently. Again, that example is for illustrative purposes only. If you hold that stock, if you don't hold that stock, it's not a recommendation to buy or sell. So make sure you do your own analysis before uh, pressing that button on your screen, right? Broadly, if we look at Nifty, the valuations are okay. I do want to see it go here, and that's when I would make profit, or rather, that's what big money could be made. However, if the P or the valuation continues to be choppy around this value, all these opportunities I'm going to capture and take them up as new investment opportunities. But if Nifty shoots up really fast to a very high level, like something like a 23,000, it's not unlikely that it could go to 23,000. It is very likely from the way it is moving right now. Uh, but if there is no pause, which I don't think that would be the case, because a pause is evident, obviously, because of the fundamentals that are underlying in this whole situation. So let me finish this part first, that this is a danger zone. If it goes way beyond this, very high danger zone, and if it goes way beyond this in terms of valuation, uh, I think I would be a fool to keep that portfolio open, just to see my profits getting hammered at a later stage. So part booking is absolutely important. Now it's up to you, as a personal choice. You want to make a 30% part booking, a 40% part booking of your portfolio. Some people prefer to be very safe and they want to make a 70% part booking. Personally, I do a 50% or a 60% part booking and pay myself for all the work that I've put in the past few months in going through the stocks and understanding their fundamentals and understanding and investing at the right locations, all of that. And this is a reward that I have to pay myself for every time I'm right in the market. Again, the exits that I have done in the recent past, which is I think about a couple of days ago, has only been on those stocks that I feel have overheated, have gone way higher in terms of the price as compared to their earning potential, right? And one such example that I have recently done is C Info Systems, or it's also called as Map My India. Now you would have, if you would have gone through my channel, then I had done a video, I think maybe about 6 or 7 months ago, on Map My India, which I said as the Indian Google Maps, and that video got a lot of views as well. So that's where I had looked at this stock in a very crude fundamental manner, and I had invested, I think, close to at about the 1000 levels, 1000 or 1100, I don't remember, but I'll put a screenshot of where and when I had bought it, and I have exited it, I think just 2 days ago. I've part booked a quantity from it, with about 110% profit on in a span of 10 months, or rather in a span of 8 months. I think I invested somewhere around May, and in December I've booked profits on it. Now there are two reasons to it. One, has anything changed fundamentally in this stock? Absolutely no. If you look at the recent quarter results, the June quarter, it made about 75 crores, excellent OPMs. In the September quarter, it made about 80 crores, 40 crores, and 39 crores of profit, 34 crores of net profit. Now, if a company is making 50% of OPMs every single quarter, that's amazing as an organization. So they're able to set aside 50 rupees for every 100 rupee sale that they make, after getting through all the expenses. Now that is a brilliant company. Now I don't want to lose out on the gains of this company, but when I look at what's the industry trying to do, then this is again a computer, it's a software stock, and if you look at it, the industry PE is close to 37. As compared to the industry PE, the C Infosystem PE has shot up to 93. When I had bought it in May, possibly we'll get a historical value around it. Let's see. Okay, when I had bought it in May, the PE of this particular stock, I think it was about 52, right? So it was also overvalued, no denying to that. During that time also it was overvalued, but as compared to where it is today at 93, and as compared to where it was at 37, I do feel it is a slightly expensive stock as compared to its pricing. However, what I've done is I've not moved out the entire position out. I have booked a part profit and left the rest of the position to gain on any further movement that would come into the stock, right? So the question of which mostly people are mostly worried about is, what if I have exited too early? So who's asking us to exit the whole lot, right? You may part book, leave the rest of it for it to become a really good, a long-term investment, right? But uh, at these valuations of 93 PE, which is what it means is for every 1 rupee of uh, profit that the company makes, you are willing to pay 93 rupees, which is ridiculous valuations in my opinion. But again, that's a personal choice. Everyone, thinks differently about it. But from here onwards, I do see the stock will slow down, flatten up a little bit. Even if we look at the charts, the prices of Mapma India have just rocketed from the time that I had bought it. I think I bought it somewhere in around May. This is a month. With I think the average price was 1100, and then you see 1, 2, 3, 4, 5, and 6. In 6 months, there is not a single red candle that has come, and I think I exited close to somewhere around 2200 or 2100. And I'll try put a screenshot of this when I did this particular section of the video. But this is basically it, right? I'm doing very simple things, as opposed to all the quants and all the uh, all the high funder things happening out there. I'm doing a very simple, clear analysis of where the Nifty is, where the stock is, and where the entire industry that stock belongs to is, right? uh, as I've said in my previous videos also, I do not prefer stocks that have P ratio of more than 0.25. At best, if the company is really good, then 0.5 is something that I go with, right? And this does not include any banking stocks, because banks could have a debt to equity ratio of you know beyond 7, 8. At times it goes beyond 10 also. So the banks are leveraged because of the kind of business. But the other businesses, I do not have a tolerance beyond 0.25 as the debt to equity ratio. So that's something that had fit, and I made this investment, and I think 110% return in 6 to 7 months is not bad, right? And I hope you comprehend with that. So again, the hunt for stocks continues, right? I have my screener always open. There are many stocks that I continuously keep shortlisting. I think I have made a video around a very good chemical stock in the past session. I'm looking at Shivalik Bimetal these days, just to understand. I'm looking at Explio Solutions, which is again a banking software company. I'm looking at Intense Tech. I'm looking at KRBL, which is your India Gate Basmati rice. So these are all into my watch list. Again, I cannot reveal which one I bought at what price unless it's a past event because of the SEBI rules, right? But you get the idea of what's going on and what's happening. I'm happy to share this query if somebody needs it. Let me know wherever in the comment section or contact on the email that is provided, and we can definitely share the query, and you can look at the same list. If it fits your criteria, feel free to change the criteria if you have to. So broadly, we are at a location where Nifty is, in valuation terms, it looks good. It's not that worrying, but I still see the macroeconomic activities not picking up. I see interest rates steady at 6.5, with a minor probability of it hiking a little bit more if inflation does not come in control. It will all depend on the harvest of the next season. It will be very critical to see how inflation pans out, and we are, on an average basis, we are still well above the 4% mark. So the macroeconomic situation and the the stock market situation do not seem to align at this point. They never did, but I still want to have some correlation. But if we go onto a cycle of interest rate cut, definitely I see a multi-year bull run coming. But it's far off in my opinion. 1.5 years. Uh, I don't see, you know, Nifty going, haywire across various levels. But I do see stock specific movement that will happen. Companies that do well will continue to do well irrespective of where the interest rates are. And uh, my way of unpegging myself from the interest rate risk is simply by acquiring stocks or companies which are fundamentally strong but have a debt to equity ratio that is as low as possible, right? Even if the interest rates increase tomorrow, the company's debt burden should not grow. Is my simple opinion to selecting stocks. That was it. I thought I would provide this interim update because a lot of the lot is asking about whether it's the right time to invest. Again, that's a personal decision, but I see Nifty going towards higher valuations, and these are the time to part book your portfolios. I part book my portfolio, uh, and I do not see these as aggressive investment opportunities. I keep looking for good companies, but I am cautious at all points of times when Nifty is at all time high. I hope this was insightful. Until we speak next time, I wish you good luck and good investing. Bye bye.